There are several market indicators to follow to determine the valuation of a particular stock. We can look at charts and figures, compare historically, and assess the situation. But there are times when nothing really makes sense. Typically, this is called a bubble, when everything is overvalued and you're not allowed to talk about it without being ridiculed. But here we are anyway. You came here for the truth, so let me unveil that for you. Today we're going to look at one particular stock. I then want to connect that in with a whole bunch of other charts. Let's begin. We are looking at the FANG stocks. This is the current trading session. You'll see that they've been trading in tandem except for one. Netflix has taken a little dive today, so we'll look at that on a longer scale. Looking at the 5-year chart for Netflix, currently sitting at 177. Over the past 5 years, these stocks have risen. It's very clear. But one has really risen above the rest. Netflix has exceeded 2,000% earnings over these past 5 years. Done incredibly well, even when compared to its peers. Looking at Google as an example, 152%. And they have performed extremely well when you look at it like that. Now, when you compare the two charts, it sort of takes away from all the impressive gains that we've seen in the rest of the FANG stocks. So Netflix, you would think, best performer, definitely the best valuation, definitely the best numbers. They must be doing really well. Well, quite the opposite. Look at this. The PE ratio, 216.85. Currently sitting at 216.85 when the historical average, going back to the 1800s, is 16. 16, and yet the PE ratio of Netflix is 216. This is completely overvalued. Now, if the stock had risen 2,000%, and you can prove to me that this company was doing very well and that it wasn't bleeding out cash and doing terribly as a company in some ways, perhaps I could agree with you. But that's not the case. These stocks here are the biggest winners because of central bank intervention. That's why they're doing well. Look at the numbers of Netflix. Just get the few basics and you will see that the current price and reality are nowhere near each other. All right, let's take a look at a few charts here. This is new information. When you look at this, Dow Jones has been rising. S&P has been rising. New record highs as of today. The 10-year yield, stagnant. Completely stagnant. Yet, that would be historically, nearly impossible to be doing this for this long because of the intervention in the market that we're seeing. U.S. hard macro data has been declining. I mean, we've been seeing that for quite some time. There's no real good data. You know, when the GDP rises, look at Obamacare. That's it. That's why it rises. More spending on Obamacare, more spending on all the garbage, and that makes the GDP rise. It doesn't make anyone any better off except the insurance companies, except the medical establishment. Obviously, Spain, you're seeing that here, the stocks took a little nosedive, whereas European stocks had risen. So they formed a little chasm in between the two. There's obvious reasons for that. Looking at the Russell 2000 and the 2017 earnings per share expectations, this seems to have been declining for eternity, as far as I'm aware. But the Russell 2000 has risen. Now the Bloomberg Dollar Index, okay? You're looking at this and you're seeing the rise, and you must think, look, the dollar's strengthening. Surely, you look at this chart, you see that. But of course, that's not the case. What has actually happened is that the euro is weakened, and against its peers, the dollar appears to be a little bit stronger. So understand what is happening. Don't just look at any chart at face value. You have to know the story behind it. Bitcoin, again, rising to some level it hadn't been at for several weeks, hitting past that 4,400 mark. Gold had broke past the 1,300 barrier, but seems to have now declined a little bit. Of course, as soon as tensions ease just a hair, the price will go down. Why? Because it's paper. It's all paper. It's not physical. And that's all for this video. I'll leave it at that. Just wanted to keep it very simple, focused on the charts. Want you to note that when you look at charts, as I said, don't just take it at face value. Don't just say it was twice as high as it was last year, therefore it's twice as good. Don't just say if it's twice as high, then the stock is doing better, the company is doing better. We need to investigate deeper beyond that. There are a lot of people out there that simply look at the charts. They look at the technical analysis, and while that is good for some, that could be profitable for a lot of people, you can't just do that. You need to understand the fundamentals. You need to understand why these things are happening. You need to understand what the mainstream media view is, and you also need to understand reality. So let's keep our eyes on these charts as always. Let's look into them, but not really take it too seriously, because ultimately, when the central banks have their intervention, they decide what stocks should be at, what all asset classes will be at. They determine, using liquidity to either dry it up or send it off. You'll see that they have that ability. Is very, very clear. So if you found the video informative, then please give me a thumbs up. Last but not least, if you found this video informative, I know you will find my books, The Money GPS, and my new release, Global Economic Collapse, even more informative. My first book is about the 4 asset classes and how to profit from them. I get into the foundation and the history as well. And my newer release is about reducing your monthly expenses, becoming self-sufficient, and earning income, among other things. So you can check that out at Amazon. Links are in the description below. Take care.